Let's break down what a Federal Reserve rate pause really means. The Fed is the main bank for all U.S. banks, and its job is to keep the economy stable. Its biggest tool? The federal funds rate, the interest rate banks charge each other for overnight loans. When the Fed changes this rate, it affects everything from your savings to your loans. A rate pause means the Fed is holding rates steady, not raising or lowering them. Why pause? After raising rates to fight inflation, the Fed waits to see if it's working, hoping to avoid a recession. They're watching jobs, wages, business growth, and, most importantly, inflation. A pause signals things are moving in the right direction, but the Fed isn't ready to declare victory. For you, this is a chance to get your finances in order. Stability in rates gives you time to make smart money moves. It affects your savings, loans, and even your credit card bills. So, what does today's rate pause mean for your wallet? Let's dive in and see how you can take advantage. No excuses. This is your moment to pay attention. Let's get started. First, your checking account. No big changes here. Most pay little or no interest, so a rate pause won't matter much. But savings accounts? That's where it gets interesting. High-yield savings rates have climbed as the Fed raised rates. Now, with a pause, those rates will likely hold steady. This is your chance to make sure your emergency fund is earning top dollar. Money market accounts work the same way. Rates are peaking and will likely stay put for now. Don't leave cash in a low-interest account. Move it to a high-yield savings or money market account to lock in these rates. A rate pause means stability, but these high rates won't last forever. Take action now to maximize your returns. Don't miss this window. Let's talk CDs, certificates of deposit. With a rate pause, CD rates are likely at their peak for this cycle. If you think rates will drop soon, now's the time to lock in a high rate for the next year or more. Open a CD now, and you're guaranteed today's rate, even if rates fall later. Be strategic. Compare terms, and consider a CD ladder to keep your money flexible. Remember, early withdrawals mean penalties, so only lock away money you won't need. Shop around for the best rates at banks and credit unions. A rate pause is your cue to act before rates start slipping. Secure your earnings while you can. Now, let's talk debt. A Fed rate pause can stabilize mortgage rates. Good news if you're house hunting or have an adjustable rate mortgage. For HELOCs and other variable rate loans, your rates will likely stop rising. Personal and auto loan rates should also hold steady, giving you time to shop for the best deal. Fixed rate loans? No change. Your rate is locked in. Credit cards are the big one. Their rates are tied directly to the Fed. A pause means your APR stops climbing, but it's still high. So pay down that balance aggressively. Every extra payment now saves you more in interest. Use this stable period to get ahead on your debt. Don't wait for rates to rise again. Take control now. Finally, your investments. A rate pause brings stability, which investors like. Stocks may get a boost, and bond prices stop falling. Companies benefit from stable borrowing costs, which can help their profits and stock prices. For bonds, the worst may be over. Holding them is less painful now. Don't overhaul your investment plan. Stick with your diversified portfolio. Keep contributing to your 401k and IRA. The key is discipline and consistency, not reacting to every headline. Stay the course and let your money grow.